And welcome. Hello, and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful Pacific Northwest, and I'm having technical difficulties. So I apologize for that. I don't know what you guys saw or didn't see. I'm sure it wasn't my best moment, but definitely not my worst moment either. So bear with me. We're back in my home studio, my home office. And as you can tell, as you know, I am not the most technically savvy person, and Zoom kind of changed things on me on the user interface. So I was looking for the record button and I have found it. So here we are live on Facebook. Once again, another beautiful Thursday in the Pacific Northwest. I hope everybody's staying safe. Hope everybody's staying healthy. I hope everybody's staying cool, especially for my friends in Texas and Arizona and Florida and Nevada and apparently everywhere in the country other than the Pacific Northwest, where it is a beautiful, I don't want to tell you, but like mid-70s, blue skies, just absolutely gorgeous. Hope you guys are doing great. Hope you're healthy. Hope you're sane. And I kind of made a mistake last week. I mentioned that I wasn't going to be doing this today, but in fact, I am doing this today. My schedule changed a little bit and I misread my calendar. So here we are together again for another 30 minutes on a beautiful Thursday afternoon. And I'm going to jump right in. Technical difficulties notwithstanding, I'm a little bit frazzled, and for that I apologize. But I want to talk with you about the Federal Reserve Board and what they're doing and what they're not doing. But boy, oh boy, they're not doing us a whole lot of favors. I tell you this much. Yesterday, they came out and raised interest rates, short-term interest rates, by another 25 basis points, 0.25%. So now the Fed funds overnight rate is about 5.25% to 5.5%. I say about because they change these things from day to day, from bank to bank. They don't loan to people, they loan to banks. But the range is about 5.25 to 5.5% on the Fed funds rate. Now, for a little bit of perspective, in March of 2022, that number was between 0 and 0.25%. So over the last, 15, 18 months, give or take, they have raised the rates by 5 to 5.25%. That is historic, and not in a good way historic. It's historic insofar as we've never seen rate hikes this aggressive and this profound. And yet, they, in their comments after the fact, after their meeting yesterday, nothing was taken off the table. We're not sure where we're going from here. The Fed doesn't know. The economy doesn't know. None of us knows what's happening next. And that is a hard place to find ourselves. I'm not going to kid you guys. I try to be as on top of things as possible, technology notwithstanding. You guys know my shortcomings. So, but I try to stay on top of these things. I try to get my head wrapped around what it actually means, like cut through the noise, cut through the clutter. Where are we? Where are we going? What does this mean? And it's hard to say. It's really a head scratcher. You're just like doing this. The Fed basically said, hey, we're raising the rates, and that's what they did. Nothing's off the table. We're still considering additional rate hikes later on this year, but we want to be quote unquote data driven, and we're going to take a wait and see approach. Now, the good news, if you want to call it the good news, is that their next meeting is in 6 weeks. So nothing's going to happen in August, and we're gonna see the Fed get back together in mid-September to kind of take their temperature of the economy, take the pulse of the economy, see how things are going, and see what's going on with inflation. And hopefully things will be moving in the right direction. But tomorrow, on Friday, we're going to get our first taste of that when the Fed's favorite measure of inflation, the Personal Consumption Expenditures Report, that's PCE for short. The PCE report comes out on Friday for the month of June, so it's backward looking. And in this particular case, we are expecting a really good number. Knock on wood, as they say. We're expecting to see inflation really start to come down, really start to take hold of all of these rate hikes that we've experienced over the last, how many months has it been? 17 months or so, 16 months or so, since the Fed started to try to unravel all the inflationary damage that they caused by their loose monetary policies during the pandemic and the months coming out of that pandemic. So we're expecting to see a really good number on inflation, and we're hoping, these are big words, expecting, hoping. Nobody knows for sure, guys. I mean, we can do the best we can to read the tea leaves, but at the moment, nobody knows for sure where things are headed. I do feel that based on the research that I've done, at least, that these data points are going to coalesce and start to reflect a reduction of inflationary pressure. And that is good. We need to see that happen for a variety of reasons. But today we had some information released showing that unemployment is still a very low rate, which should be a good thing, right? We should be celebrating the fact that people have jobs and people haven't lost their jobs. But unfortunately, that's not what the Fed wants to see happen, because when people have jobs, when there's wage pressure inflation, meaning when salaries are going up, people have more money to spend on things like vacations, like cars, like hotel stays, like new clothes, like new whatever. And that tends to push prices up. So the Fed wants to see lower employment rates. The Fed wants to see lower salaries and lower income. And when they do that, and as they do that, it will help them with their policy decisions in theory, and it will also help with the rate of inflation. We also got a number on the gross domestic product, the GDP, released today, which was a lot stronger than we wanted to see happen. And again, we can torture the statistics until they give us whatever information we want. And I don't know exactly where we are at this time. I honestly don't know. And I'm not embarrassed to admit it, because I don't think that the Fed really knows where we are either. I think they're kind of closing their eyes like this, and they're aiming at a target, and they're hoping to hit the right thing, and at the very least not hit the wrong thing. But beyond that, there's just a lot of different information going on, a lot of different guidance, and a lot of different guesses. So we continue to kind of swim through these waters, and the expectation eventually is that we'll reach the shore. And that's the good news. The question is, what shore are we aiming toward? Well, we don't know. You're out in the ocean, right? You have no idea unless you can get your bearings from a star. Which direction are you swimming? Are you going north? Are you going south? Hard to say. What you can say is watch out for the sharks, right? Watch out for the riptides, and hopefully you'll get to someplace safe, and hopefully that will be a good outcome for us. And I think that that's what the Fed is hoping for as well. I know that they are economists, they are government bureaucrats, they've been in academia, they've been in government pretty much their entire lives. I don't think very many people who work at the Federal Reserve Board or who participate in the Federal Open Market Commission, Open Market Committee, that's the group that makes decisions on rates. I don't think any one of these people has had to make payroll before. I don't think any one of these people has owned a business before, or has been in a position where they've had real concerns, because, you know, the business of government and the business of academia, that rolls on undisturbed by the realities of the economy, the realities of life. Government seems to always be in growth mode, as does academia. And so a lot of these people, a lot of these institutions have never really felt the true pain that they're inflicting on the economy and on people working to just get through another month and pay their bills on time and pay everything in full. And so rates keep going up, short-term rates. In theory, the bond market should like this. Right now, it doesn't like this. And why does the bond market like short-term rates going up? Because it signals that these statisticians, these policymakers, these bureaucrats are really trying to contain inflation. So in theory, that should be received favorably. But there's other things going on that make the markets really, really nervous. We had an auction today of 7-year Treasury notes. So that happens quite regularly. And that's how the US government, that is, funds its debts, right? I mean, we are, as a country, living on our credit cards. There's no other way to describe it. I think it's the easiest way to kind of make this as clear as possible and as succinct as possible. As a nation, our federal government is living on credit cards. And I've been there like 30 years ago when I was much younger and in a totally different state economically, totally different state physically. Like I was in Texas. I wasn't even in great Washington state, but I lived on credit cards as well. I just wasn't making a lot of money, and I was borrowing a lot of money and racking up credit card debts like many people have experienced. And that's what the US government is doing right now. But you know, they're different than we are. I had to actually make payments to Visa and Amex, whereas the US government can just float more debt. And that's what we do. We just float more debt, and someone has to buy that debt. Someone has to give us a loan, basically. Imagine the US government applying for a credit card. That's kind of what they do when they have auctions for treasuries. Treasuries are just basically IOUs written by Uncle Sam. It's like, hey, let me run my credit card. Now you just tap it, right? Back in the day, you swiped it, or not even swiped it. You had that big chunky machine that like printed your credit card information in triplicate, and you signed it and whatnot. I don't know if you guys remember that, but I sure do. And when you didn't have that big chunky machine, you just took the slip and you took like a smooth pen or even a rolling pin from your baking sheet, and you just rolled it over the credit card and the credit card slip until it made an impression. That's way back old school. But the US government basically has to float debt every month in order to make its bills, because they play by rules that, you know, just don't apply to us as lowly people. And so they had an auction today for 7-year loans, basically IOU in 7 years, X amount of money. And it was not a very well received sort of auction, meaning that, you know, sometimes the appetites that investors have are very big and very strong, and sometimes they're not that solid. And today it was not a solid sort of auction. The people, the observers for these things, graded it or rated it as a D auction. D like Delta, D like, right? That's Homer Simpson thing. So, you know, debt is a problem. There's good debt, of course. Mortgage debt is good debt. But then there's bad debt, and there's debt that just continues to grow and expand without any real idea of how we're going to pay it off, what needs to happen in order to get it paid off, and where we go once we hit our debt limit. And you know, unlike the US government, we have limits on how much money we can actually borrow. We have limits on how much money, how much debt some institution or some creditor is going to extend to us. At some point, you hit the wall and then you're finished. Whereas the US government sits down and has a vote to say, hey, let's just increase our debt ceiling. And presto, they can borrow more money. What a unique and amazing situation they find themselves in, and we find ourselves in. But we don't have that luxury as individuals. And I know that there are people who are starting to really feel the pinch of the pinch of debt coming due, the pinch of credit card debts, the pinch of student loans, the pinch of car payments. There's a ton of debt that people are carrying right now, and it's becoming more and more expensive to carry that debt. Every time the Fed raises interest rates, that gets passed directly through the banks who make loans to people like me and you, and it gets landed right on our shoulders. And so at some point, the debt becomes really hard to manage. And the question becomes, how do we pay the balance off? It's one thing to be spinning your wheels, no traction, just staying in neutral and making the minimum monthly payments. That's painful. And it's costly because there's no real way for us to get our arms around that, it feels like. And again, I've been there. I called Visa once and asked if they accepted American Express for the minimum monthly payment. Like, that's a lot of debt. And the question is, how do you get out from under that debt? And the answer is you take out different kind of debt. And I don't mean to be playful or glib or anything like that. It's this not intended to do that. But unlike the federal government, we can't just snap our fingers and say, I'm borrowing more money. But we do have options. We have resources. We have opportunities. And one of those opportunities is in the homes that we own. And we have the opportunity in many cases, because we have a ton of equity, that we can borrow money against the equity that we have in this house, in our house, either this home in particular for me or the home that you happen to own. We can borrow money against that. Now, I know that a lot of people are saying, I don't want to borrow money at 7% or 7.5% when my current mortgage is at 3%. And I totally sympathize with you. I get it. In fact, many of you, I helped arrange that 3% mortgage in the first place. And it's a beautiful number. It's a beautiful mortgage, and that's great. But you have a lot of money sitting in your home right now, and that money does nothing for you until you either sell the property, which you don't necessarily want to do, or until you access it by taking out a cash out refinance and using that extra money to consolidate your debt. And I know that a lot of people are going to say, well, yeah, but if I go from a 3% mortgage to a 7.5% mortgage, my house payment's going to double. And yeah, that simple math kind of works. I agree with you. I get that. But how much money would you be paying off on other debts that are going up exponentially higher than 7.5% in interest? What sort of debts are you carrying right now on your credit cards? What sort of debts are you carrying right now on your car payments? What sort of debts are you carrying right now on your home equity line of credit or on other things? I got a home equity line of credit on this property as an example. Right now, it's a really good interest rate because I was fortunate enough, and I'm not going to break my arm patting myself on the back, but I saw the writing coming on the wall. And so when the institution that made that loan to me gave me the opportunity to fix, quote unquote, fix or lock my interest rate for 2 years, I took that opportunity. So I'm sitting at a home equity line of credit right now on this house that you see behind me at like 4.5% interest. And that's great. Yay, that's awesome. I feel good about that. But here's the catch. In May of 2024, that lock is finished, and my rate is going to jump to whatever the market rate is, probably double digits, probably somewhere around 10%, if not higher, depending on what our friends at the Fed do between now and then. It's a very, very painful thing to go from 4.5% to 10 or 10.5%. That's a huge jump. And I'm not gonna be in that loan when that time comes. I'm gonna do whatever it is that I have to do to make sure that I'm not paying 10% interest or higher at a home equity line of credit. So I'm already making arrangements right now within my own financial plan to be able to have the money available in, I don't know, what is that, 8 months or so, 10 months, whenever that time comes, so that I'm ready to pay that thing off and not be charged 10% interest. Now, if you've got credit cards, your interest rate's probably pushing 20% right now, the way the Fed continues to hike their rates. If you're sitting on a home equity line of credit right now, you probably are already at the 10% interest rate. And that is a huge expense. And the question is, again, most of us don't have a plan as to how to pay that off. Maybe we're able to make the payments. That's great. Of course, it's better to make payments than not make payments. But what is the plan to get rid of the balance? That's where we're really getting stuck. That's where we're really starting to see a lot of cracks in the plans, because I can tread water for only so much time before I get tired, before before other things happen. And if we're sitting in adrift in the middle of the ocean and we're not really sure what direction we're even headed, treading water or swimming becomes a really difficult proposition for an extended period of time. And if you equate that to your financial situation right now, and you're struggling with credit card debt, home equity line of credit debt, car payment debt, things of that nature, you didn't get your bonus, you're not getting your raise, you're not keeping up with the cost of living, at some point, something's going to have to give. And before that happens, what I suggest is that we talk about accessing accessing the equity that you've got in your home right now and using that money to make all of those other debts go away. Yes, your housing payment will go up. I guarantee it. If you refinance right now, if you take money out of the equity of your home, your housing payment definitely goes up. There's no question about it. But how much of your other payments go down or disappear altogether? What is the balance between those two things? Yeah, my housing payment went up, but my other debts went away. And so, yeah, I'm paying a higher housing payment for sure, but I've eliminated all my other debts. I've zeroed all that out. Visa's paid in full. Amex is paid in full. My HELOC is paid off, and I don't have to worry about those rates and those payments continuing to go up. I'm no longer treading water. I'm on firm ground. Yes, it might not necessarily be the destination I set out for, but I'm out of the ocean, and I'm out of immediate danger of drowning, of becoming tired from treading water, of just basically not knowing where I'm going or how I'm going to get there. And that is something that we can definitely talk about, because I don't feel very confident in this Federal Reserve Board. I don't know what's coming next. I'm afraid to say that I don't know that they know what's coming next, but I don't think that we're out of these woods yet. I think there's more pain coming. Hopefully we'll see some relief tomorrow when we see the personal consumption expenditures number come out. But in general, we still have a ways to go, and things tend to get a lot messier before they get clean. And again, I don't trust. I'm looking. Oh shoot. Oh, okay, we're good. We're good. I thought we were already over time, but we've still got a few minutes. As I was saying, I don't trust these guys. Not because they're bad people necessarily. I don't know them. What I do know of them is that none of them has worked in the private sector before. None of them has had to make payroll before. None of them has been laid off before. None of them has been in a situation where they just didn't know where their next meal or their next deal or their next paycheck was coming from. Because again, academia and government seems to have a revolving door. And once you get connected enough to the point where you're working in these institutions, you seem to be somewhat insulated from whatever happens outside of these institutions. So I'm not saying they're bad people. I'm not saying they're good people. They're people, and people make mistakes. People have shortcomings. People have blind spots. People have absolutely different priorities. And I don't know what these guys are thinking, guys and gals. I don't know what they're thinking. I don't know what's coming next. What I do know is that in my experience with these things, they seem to take longer to unravel and to rebound than we think, than we expect, than we are told, than we are prepared for. And there's a saying about, like, how did things go so sideways? And the answer is usually slowly at first and then very quickly. And that's where some of you guys may be finding yourself. And I hope that's not the case. I hope I'm just speaking to a void of people, a blank wall of people, none of whom have financial troubles right now, none of whom are really worried about how to make all their bills and how to take care of all of their expenses. I hope that's the case. But if it's not the case, then I want to remind you, I want to be really top of mind for you guys, that we have options. If you own your home right now, we have options. They may not be the best options. It may not feel like the best deal right now, but let's crunch some numbers and see what it looks like to take cash out of your mortgage and have a higher housing payment, but have zero other debt payments, zero other obligations. Let's see what that looks like. Let's talk about what kind of relief that can give you in the interim until this does calm down, until things do kind of stabilize a little bit, because good times will be following bad times. It is a cycle, but right now we're in that cycle of the downward spiral, and we're not there yet. We have not hit bottom yet. And so as things continue to unwind and continue to kind of move in whatever direction they're going to move in, I would like to talk with y'all about doing some refinancing work, getting some of your equity out of your home, at least for the short term, paying off these other debts, getting comfortable, at least getting whole with all these other debts so you don't have that hanging over your head. And then you have the opportunity to kind of catch your breath, figure out what to do next, wait and see. There will be refinance opportunities. I don't think they're coming in 2023. I wanted to say that, they're going to come. And earlier on this year, the guidance that we were receiving and the information that we were reading and our research suggested that by third or fourth quarter, we would see mortgage interest rates starting to really come down. That might take a little bit longer. It might take into 2024 before we see that happen. I'm not 100% sure yet, but at some point they will come down. I don't know that they're going to come down to 3% again, but they might come down to 4.5% or 5.5%, which is a whole lot better than where they are right now in the 7% range. So that would be a great opportunity to refinance, but you have to deal with the immediate threat first and foremost. As you guys may recall, I teach Krav Maga. That's Israeli military hand-to-hand combat, self-defense, whatever you want to call it. And one of the main principles of Krav Maga is you have to deal with the immediate threat first. And if we're dealing with our financial situation right now, the immediate threat may very well be that the Fed keeps hiking rates, your credit card payments, your minimum payments due keep going up, you're running out of cash, you're running out of options, and at some point you're going to start missing payments. If that's a threat, if that's an immediate threat, then worrying about what the mortgage interest rates will be later on is not nearly as significant as worrying about that immediate, like, what do I do with this home equity line of credit that I'm sitting on right now that's charging me 10 or 12% interest? What do I do with my credit cards that are above 20% interest, and I don't have any way to pay off the balance? I'm barely treading water. How do I deal with that? That's the immediate threat. That's what I'd like to talk with you guys about. That's what I'm offering my services for. Please give me a call. You know where to find me. Things are getting tricky. Things are taking longer to unravel on inflation. There might be some additional layoffs. There might be some additional problems coming. The best time to ask for money is when you don't need it. So if you're in a situation right now where you think you may need money down the road, let's talk about it right now and take care of that before it becomes a difficult process where you won't be able to get money down the road. I know these are hard conversations. I know this is not the most cheery sort of conversation, especially as I'm talking about the beautiful summer and those beautiful blue skies and the sunshine and everything else. But sometimes we have to have tough conversations and look at the totality of the situation and figure out what do we need to do in order to get ourselves down the road. And then once we're out of this mess, once we've addressed the immediate threat, then we can think about other things that we need to do in order to get back to a different state. I know, again, that's not the cheeriest thing, and for that, I'm sorry, guys. I was hoping that things would go differently with the Fed, but right now, the markets are just not showing a lot of love and a lot of confidence. And so we have to take it as it comes. We have to take the reality, not the wish and the hope, but we also know that things always change. And there will be better times coming. There will be a resolution to this. Until then, let's figure out a way to help one another. Let's figure out a way to address the immediate threat that we're facing. And let's figure out a way to make the best of the situation. So with that said, please, please, please give me a call. You know where to find me through Facebook. If you're watching this, then you know how to reach me. Please don't be shy. Even if you want to talk, no obligation, no commitment. Let's just figure out what's going on and if there's something we can do. Until then, I'm going to see you guys next Thursday. Hopefully the weather will continue to be this beautiful, gorgeous sunshine. Hopefully you folks in Texas, Arizona, Nevada, et al. I hope you guys get some relief from the heat that you're getting. And until next time, first, thank you so much for spending some time with me. Until next time, please stay safe, stay healthy, stay cool, and stay sane. I will see you next time. Y'all take care.